Hey, good morning. Let me remind you that trading's risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results, but please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Ni hao ma. Hello. How you doing? Hi, my name is Wayne McDonald. I am the Chief FX Market Strategist for TradersWay.com, a boutique foreign exchange trading brokerage firm that would like to earn your loyalty and respect. And to do so, they are investing into your success today by providing educational resources like these webinars, with the hopes that you develop things like patience and skill and discipline, understanding of fundamental analysis and technical analysis. And maybe one day, if you do feel confident enough to trade real money in the market and take on that risk, that you'll choose a trading partner like Traders Way to be your, the prime broker for your successful Forex trading business. So please look at these webinars as an investment into your success today. And if tomorrow you become a success, you will choose Traders Way and pay it back. So anyways, thank you for being a client. Been trading Forex, looks like about 15 years, and so I'm here to share. Sexy Crabber finally made it to a live session. Right on. Thank you for the NFP webinar. Hey, my pleasure. That worked out really nice, right? Cool. Just an update in case you think, like, where did my screens go? Oh, I got a screen. You're like, what? So I'm down to one screen. Terrible, right? One screen. But the cool thing is that's actually attached from the wall. It's hanging that far from the wall. Cool, right? And check this out. Right? So I can twist it and I can move it. It looks straight. Yeah. So anyways, moving along. I think it's going to look really nice. So there'll be two more of those 43s, one on either side. And then on either side of those, 3 1080p's, 3 1080p's. So down to just 9. So I went from 18 screens down to 7 screens, now bumping it up to 9. So at the end of the day, I'm pretty sure I'll be happy. And I'll go from 18 to 9. Yeah, cool. Anyways, so that's just one of the fun things I was doing over the weekend. I hope you had a nice weekend. Okay, so lots of interesting things have happened. We got that giant move last week, and it's really concerning in the sense that I wanted yen strength. We got yen strength, but it moved so fast, right? It moved so fast and so far, really. I mean, the speed is one thing, but, imagine you shorted all the yen pairs, let's say, going into the new year, which we knew was the strategy. Everybody knew that. And what if you said, well, I'm going to put a 300 pip or a 500 pip limit order, right? And see if I can stay in this all month. quite a few people may have done that, right? Problem is they were out in a couple of days, not 4 weeks or 6 weeks. So we might have hit all our targets. I don't recall that ever happening before, but it's, these unusual things are not that unusual. So anyways, we need to pay attention. So the key to a lot of this is still looking for your larger levels of support and resistance, right? And remind yourself what you're doing. And I would pull myself out of the smaller time frames and look at where the key levels of where bulls are going to buy and where bears are going to sell. Decide what you want to do and wait for those, in your analysis, the more important levels. Wait for the market to reach those more important levels, whatever the more important level is that you've analyzed, but sort of make it prove to you that it's ready to head back down. And the interesting thing about that is along the way, so let's say you wanted to be a bear again, right, on the yen pairs, but you think the higher level, let's say another 50 or 100 pips up is actually where more bears are going to be, then you can be a bull on the shorter time frame as you work your way up. Just be cautious, okay? Ow. Does that make sense? So well, let's just go through the market. I'm okay going into this to say typically this time of year I look for like a stock market decline and such, right? And Japanese yen strength and such. But because of the velocity and the amount that the yen pairs have already moved, I'm very open-minded to essentially being neutral. But if it fell again, I'd kind of be on it, right? Michael says, so that's not letting the door swing both ways. It sort of is. Okay? It sort of is. But what you're doing is you're separating medium term from short term. Okay? I mean, the other thing you could do, Michael, is wait for it to, move 100 pips up and then start to look to sell. But what if it moves up 100 pips and then 200 pips and 300 pips and whatever? Probably not, but, So like, for example, like euro dollar is a great example. I look at this and I say nothing's happening. Right? Morning, Daniel. And I say, well, nothing's really happening here. There's a mild level of support and resistance in here, but this would be the key area, right? And I would mark that and say, I'm going to be extra conservative or cautious, let's say, because what's happening in sort of the risk on, risk off, risk on, risk off stuff that we've been seeing. Okay, does this look like something I would slowly trade up and then trade down? No, not on that time frame, right? And even now, because it's range bound, even on the smaller time frames, it doesn't even look that good here. But I think what you'll find is on some of the yen pairs, it looks better to be short-term long, but still long-term short. Does that make sense? In that case, because of sort of the time of year and such, I don't think I want to just like be out of the market and wait for a better trade. It may just be better to be in the shorter term while you set up the longer term. Yeah, yeah, that's right. Yeah, we'll get there, but that is definitely one that's on my mind. Okay. And as I covered with the swing trading group yesterday when the market opened, I think the Swissy pairs look better than the yen pairs. But that's just me. Here's a Kiwi move, right? Is it at a level? Is it at a key level of resistance? And the answer is no, right? No, there's no increased uncertainty. Okay, Michael, increased uncertainty is like geopolitical risk, where you're not certain if a war is going to start, right? You're uncertain about whatever, Macroeconomics is macroeconomics. Look at the data. Okay, so as I've explained, I believe the mass volatility we've had since December is simply related to a stock market that has rallied for 10 years because the Fed pumped trillions of dollars of free money into the market. And on the Fed meeting, in which the Fed said, okay, we're essentially at neutral, which means there's no stimulus in the market at all. That was the day it started coming down. And it's not coming down because people are selling. Now, you might hear that in the news, but I don't believe that's the case. The market's coming down because people started taking profit on the most overvalued stocks in their portfolio, things that are like 20, 25, 30 times earnings. Like what? Apple? So they took profit on all of that, and the market started to drop. So anyways, once you take profit on the best part of your portfolio, now you want to get rid of some of the losing investments in your portfolio to offset your capital gains, right? To offset your taxes and stuff. So I think a lot of that is happening here, much more than the end of the world and like uncertainty. What uncertainty? Right? Like, for example, uncertainty. We knew, I've explained with certainty, doesn't mean it was going to happen, but I've explained to you with certainty that at the end of the year and the beginning of the year, right, from December to January, the Japanese yen would get very strong. You would see a big move in the yen's down. So, like, what uncertainty? Okay, sure, it happened a little bit earlier this year than typical, which is still okay. And then when January hit, it fell like a ton of bricks, but, well, that's what we thought it would do. Yeah, okay, faster and farther, but now what? The arrow was too close to the center of the target? Like, all right, bullseye. Okay. So, yeah, try not to get into the hype of that the media presents. Yeah, I'm going to put it up there, Jenna. There was a problem, but I'll have it up there today. When did I explain it? 3 weeks ago, 6 weeks ago, 9 weeks ago, 12 weeks ago, 3 months ago, 6 months ago, 9 months ago, and 12 months ago. And then last year, the year before that, and the year before that, and the year before that. Cool. Yeah, my pleasure. All right, cool. So, like, what do you want to do with this? Well, this is sort of like the first area to seriously consider selling if you wanted to sell. You know what? This chart is so messed up and so old now. Let's redo it. Okay. I'm actually a little bit surprised we made it through here. I just want to mark this because it's going to be important in the future. When in the future? I don't really know. All right. So anyways, boom, 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 boom. On a weekly basis, this is a bearish entry. So that'd be interesting. If we saw on a 15-minute chart like a reversal pattern in here, that would be worth a shot to the sell side if you're going to be a bear. right? Maybe in here. So maybe on a 15-minute chart, well, for sure you want to see a lower low and then a lower high, right? Or even better, a double top, right? And then even better than that, a double top. I can't grab it. Oh. A double top with a lower low, then you set up the lower high. Yeah, well, I've been doing these webinars, yeah, 13, well, more than 13 years. So, cool, I'll be around. Joe, just make sure you open an account at Traders Way, pay it back. Does that make sense? I'll hold up my end of the responsibilities, you hold up your end of the responsibilities. Cool. So here's probably what you're thinking. Wayne, this is really unclear. Yeah, I know. What do you do when the yen pairs drop 1,000 pips in 1 hour, like they did on the pound yen, and then give you almost 100%, or in fact, in some cases, 100% retracement in a day? What do you typically do? What does it say in the textbook? There is no textbook for the stuff like that. So you need to recognize that this unusual behavior is just adds a little bit, well, adds risk, because your technical analysis is going to be diminished by this. Like, for example, it's just like we'll talk about monthly pivot points, right? This will affect next month's pivot points, right? Or even this week's pivot points are affected by last week's moves, and now the pivots are totally wide, but you know, it's not typical that the yens will move 1,000 pips in a week, but now weekly pivot points are calculated based on that 1,000 pip move, because that was the high and low and close of last week. So that just means the pivots are spread wider than normal. And what it does say in the textbook is very often you don't get like an M4, M2, or M3, M1 type week. Very often you get S1, R1 inside weeks because of the exaggerated pivots, right? Does that make sense? Ian says no, well, sort of, Ian. Sort of, yes and no. It's not just those, and we'll get to that, Ian. Okay, and that kind of bugged me because that's what I heard on, like, I was listening to Bloomberg Radio, and they're like, oh, it's the Aussie. It's definitely a China play. They're selling the Aussie because of the retraction in the, you know, the ISM out of China, and you know, Chinese people can't afford $1,000 iPhone. Dude, when was the last time you were in China? I've been all over China. I didn't see like poor Chinese farmers, right? Dude, you go to China, they can afford $1,000 phone, but the thing is, nobody wants a stupid iPhone for $1,000. That's the problem. What? iPhones were cool like 12 years ago when they came out, and you're like, wow, you can listen to music and use your phone. I mean, come on. Tim Cook does not have anything interesting in the pipeline. I think that's the bigger news. But anyways, so they were isolating it like this is a China play, and what? Boom, Aussie got sold off specifically for China. Yeah, but then we started looking at a lot of other pairs move too, and so it's oversimplified. I think, again, first of all, it's going to be confirmation bias. This was my opinion last year and the year before and the year before and the year before, and I was explaining this year the same as I always do, that it's profit taking and sort of taxation issues due to year end of institutional money managers. I mean, right? You know what I mean? And that's why these things move. Now they're more dramatic now, but maybe the market's smarter. Maybe everyone's doing it now, or maybe it's automated, or maybe people take advantage of it. But it's not simply because of that macro issue or that macro issue. I think it's just the way business gets done. Right? At the end of the year, A stock portfolio manager wants to get paid a huge fat bonus. Right? Does everyone agree with that? That any size of stock portfolio manager, whether they're managing $1 million or $1 billion, they want to get a big fat bonus at the end of the year. The stock market is not mark to market. You have to understand the mechanics of trading. Forex is mark to market, and what that means is our currency positions get revalued every second. And it says, oh, your pound is worth this. And then 1 second later, oh, the pound is worth that. And you're collecting the profits and losses in real time. You don't know, right? But as a stock investor and you have $1 billion portfolio and you're up, let's say 200 million for your clients, and you're going to collect 10% of that. Let's say 10% of 200 million. Say, what? Yeah, right? You want your 20 million bucks, right? Don't you? But the thing is, your portfolio isn't mark to market, so you're going to have to take profit to get paid. So you get paid. Now, the question is, when's the best timing to take profit for your clients? Some want to take profit in December for tax reasons, and other clients need to take profit in January for tax reasons. So they either need to pay taxes soon or they want to pay taxes later, but you got to take your profit. So now you take your profit, you pay yourself your 20 million, but now what? What about that 180 million? Well, if you leave it in cash, your client's going to call you up and say, yeah, give me my money. You're like, whoa. No, we've invested it, right? So as soon as possible, they're going to buy everything back. Right? Let's say you hated Apple at 220, but you love it at 180, and you buy it all back. Or, more interestingly, and I'm hoping, and I gave you this speech a year ago, so we'll see if it happens this year, they sort of buy some back, but they start buying Europe. I hope you remember this conversation, where they look at valuations in the United States. Right now, they're at 16 times earning. They were at 20, 24, 25 times earning, 30 on some, right? 30 times earnings is very, very expensive. I think in the top 96 percentile of how expensive a stock market can be. So it makes sense to take profit on the most expensive stocks, or to say differently, your most profitable stocks that you bought 10 years ago, right? So now what do you do with let's say, a larger chunk of your money than you've done in the past 10 years? You start looking for better deals, so you start buying European stocks. And I've been telling you, buy Dutch companies and buy German companies, right? And so the valuation starts kicking in, right? You see what I mean? And so dollar weakens, the stock market goes up, dollar weakens, and euro starts going up. That's what I would like to see, because then we save Europe, and then Europe gets its act together. Now, that might take 100 years, which is fast for Europe. But anyways, maybe we fix Europe, and then we save China. Now, the EM play is slightly different. Okay, that's slightly different. But yeah, that's on a different track. So anyways, pick your lines, guys, but tell yourself you're not certain. See, where I think amateur traders, or let's say newer traders, or let's say all traders, where they lose money is where they're certain it's going to fall. You understand that? You're like, I know this is going to fall. That makes you a degenerate gambler because you're betting. What I'd rather you say is, all right, this is a heck of a retracement, okay? And maybe we lost all the bears here. Maybe all the bears took profit here and here. And you should say, well, that makes sense, right? If you sold up here a week or two before the big drop, or even a month before the big drop, and you're like, yeah, I'm going to stay short till the third week of January, then you're going to, let's say, put a limit here and put a limit there. That's out of the textbook, isn't it? If you were short way up here and you're like, yeah, I'm going to do a monthly swing, I'll take half off here, I'll take half off there. Well, now you're 100% off. Okay? So now you have to tell yourself, all right, if you reshort, man, I still can't grab that. There we go. If you're going to reshort, oh man, this is such a mess. Come on. There we go. If you're going to reshort, the first step of the whole process is to say, that is the price in which I will be interested in maybe selling. Okay? By the way, be careful. Weren't you saying it was going to drop from the 5 EMA? No. See, I don't say things like that. I say if you're a bear and you're looking at like a 4-hour 5 EMA, for example. I don't know what you're talking about. 4 hour 5 EMA is what you said. Drop from the 5 EMA. Okay. If you're looking at a 4-hour 5 EMA, and let's say you're a bear, what can you use as resistance? See, that's way different than me telling you this is going to fall. If you're a bear and you're looking for resistance, what are the things you can use for resistance? You can use a pivot point. You can use a psych level. You can use an EMA. Okay? You can use price action. Okay? And so, yeah, if you were a bear and you were looking at this pivot, okay, and you had a 5 EMA there, is that legitimate resistance in which you can consider selling if you're a bear in a bearish market? Yes. It didn't work. So what? Looks like probably it hung in there for 5 hours and then failed. Okay? That's why they invented stop losses. You had a hypothesis. Now, did you see an entry in here? I'd even, where did, on a 4-hour you didn't get an entry. So it was about here. So yeah, so you sold it and it only worked for 1, 2, 3, 4. Yeah, so it worked for 4, maybe 5 hours and then failed. Decent setup. Unless it was this one. It might have been that test, actually. But anyways, well, whatever. Okay? Well, it's a trade plan. It's not that they work. Be careful with the language. I'm being nitpicky, and maybe you are too, maybe you're not. But if you want to be a bear, I don't know if, and I'm telling you got to be cautious. The plan in January was to be short all yen pairs. And we were right. Okay? Now that's over. Maybe. That is the big news. We hit the bullseye already. What happens from here? I don't know. It already moved 1,000 pips. What more do you want from me? Gee whiz, I told you 6 months in advance it was going to fall the first week of January. Fell 1,000 pips. And now you're like, Wayne, well, you missed the 5 EMA for me. Well, what the hell do you want? Right? So anyways, it moved. Some of these moved, like the pound yen moved 1,000 pips. What more do you want? 3 months in advance, 6 months in advance, it was going to fall the first week of January. Like, my gosh. So they fell 1,000 pips. Okay, so now what? I'm like, I don't know. We got the move. Maybe it's over. Maybe people got what they wanted, and everyone did it the first week this year instead of the first and the second. Who knows, right? Hey, Azil. So, going back, if you are still a bear, see, I don't know. I keep telling you, I don't know if I'm still a bear or not. But if you're a bear, if you've made your decision, you need resistance. Where's resistance? Well, there's a big, fat monthly pivot. It's not your typical monthly pivot, but this is your weekly M3. Okay? Can you consider that as resistance? Yes. Now that's a strategy, right? Now that's the strategic part. What's the tactical part now? If it comes up and then makes a lower low, you set up like a lower high and you sell the hell out of this. Okay? That's called technical analysis. That's tactics. So if near this pivot cluster, if you're a bear and you see a reversal pattern, maybe you should wake up and take a shot and then manage your risk, because it might come down and you put a stop here and it pops up and you lose some money. Well, that's why they invented stop losses. Don't lose a lot of money and you'll be fine. You see what I mean? Remember, it's all risk reward. Like, is it plausible to a very high degree you think you will make money on that trade? And then once you take the risk, because the reward is worth it, then manage the risk. So like, for example, if it did do that, okay, where would you put your stop? Well, probably here. So how many pips is that? Let's say it's 50 pips. Okay, I'd like to have at least 50 pips before we get here, but that's just so I can let's say move my stop to break even. But what's the actual target? The actual target's way down here, which I think is unbelievable on a weekly basis. But, you know, what if we had one of these weeks? Is it worth the 50 pip risk? If this is your realistic target. Now, I know you're selling a weekly and getting out at a monthly, but because this was so big, I don't think we're going to have, I think we're going to have an inside week, right? So what I said actually an hour, half hour ago, is if you sold here, remember I said the inside week, I would use the S, that's not S, oh, here it is. I would use the weekly S, the weekly support, okay? And then weekly R, I guess, is here, right? So I would use these pivots, which is unusual. Okay, this is not your everyday kind of move, but I would assume these pivots are the key pivots for the weekly. That we're not going to go any higher than weekly R. And we're not going to go any lower than weekly S, weekly support or weekly resistance, okay? So that means it's not going to go higher than 75. It's not going to go lower than 70. Okay? So if you take a shot here, the best you can hope for is down to 70. So where are we now? 73. So there's 300 pips in it for you. Would you risk 50 to take a shot if you saw a reversal pattern at a cluster of resistance? You see, like, it's way more than, Wayne, you told me to sell there. Well, I didn't tell you anything. I told you how to analyze it and make a decision. If you are a bear and you recognize the weekly and the monthly resistance, and you took advantage of pivot point theory that says in this situation you'd look at an inside week, and then you notice that the weekly support is also the monthly S2, so you got weekly S1, monthly S2, that produces a potential, we don't know if it's going to go there, but a potential of 300 pips. Would you take a shot if you saw a reversal pattern at a resistance cluster as a bear? You see, like, that's a trade plan, right? Yeah, you'd be short here. Yeah, you'd be short here is the best one. You can do it here, but that's pretty aggressive. Okay, this is the money maker. That's the one that puts your kids through college. Okay, guys? And thank you to whoever asked it. I know I gave an answer exaggerated for effect, but be careful with the language, right? In like not that you were swearing, but I don't tell you to do things. I didn't tell you to sell a 5 EMA at resistance. But if you're a bear and there was a resistance of a cluster of resistance for multiple reasons, that would be an area in which you would look for bearish technical patterns to sell, and then you would manage the risk. And if you lost 30 pips, I'm like, welcome to the real world. You sold off a cluster of resistance and it went up anyways. Well, that can happen, but that's exactly why I use a stop loss. So, like, right? See, I would rather sell at levels like that and lose money than sell at like random places where very often when I look at people's trade history, I see they're selling like 40 pips after resistance, for example. I'm like, well, what's that all about, right? They're late or they're early or there's something like, I'd rather you sell at the cluster and lose a little bit of money than do a lot of other mistakes. So you're a bear, you sold at resistance with a reversal pattern and you still lost money after all that? I'm like, hey man, that happens. Don't worry about it, bro. Thank God you didn't lose a lot of money. You see, that's what trading's about. So then you move on to the next trade. Okay. Now, if you went to like going back to this, if you sold this 4 hour 5 EMA, which would have been here, and you sold it without a reversal pattern on a smaller time frame, then you're not listening. All you did was sell at resistance because it was resistance. In particular, at a crazy, right, volatile market, well, then you paid the penalty. Okay. If you sold here, so I just marked it. If you sold here, okay, and it fell for 4 hours, maybe 5 hours, and you would have had your stop. Well, this didn't exist, so you would have had a stop here or here or something, right? And after 4 or 5 hours, you probably should have moved your stop to break even, and then you got nailed out of it, right? Yeah. And then you can see this is a beautiful roll reversal. So a bull bought this, and then you got another roll reversal, bull bought that. Cool. You see what I mean? In this case, bulls made money, bears had an opportunity and removed the risk. Right? Remember, there's just two people in the market, right? So let's say this whole move is just craziness. Let's go back to non-crazy. Right? A bull would have what? Bought the dip. A bull would have bought the dip at the roll reversal. A bull would have bought the dip at the roll reversal. Okay? And then that's the end of NFP, right? So bulls made money in this market. What did a bear do? Okay? Maybe took a shot here. Look at the 5A cross up that takes you out of this down here for profit. Okay? So a bear was not supposed to lose money on that. Okay, maybe a bear took a shot in here. Maybe that was short-lived, right? No entry here for a bear. No real entry here for a bear. So, I can't imagine bears did terrible there. And bulls had it easy. Straight up price action, right? And look at these trades, right? You had 5 hours to be ready for that. You had probably 20 hours to be ready for that. Same here. And they're simple roll reversals, right? Isn't it wise after a flash crash? Well, Renko, maybe. But remember, if you're a professional money manager, like there's managing your own capital. That's one thing. Okay? But as a professional money manager, that's when you're needed most. And you're supposed to be doing your job. Okay? Well, AMFX's bears made 500 pips and went on holiday. Well, but the thing is, like, remember how I've taught you over the years to always have a stop and always have a limit? Even in Bloomberg, I did an interview with them on TV, and we're talking about, When I trade, I have two stops, one for loss and one for profit, and my actual entry is here, right? So if I was short, this would be my target, one to take profit and one to take a loss, really, right? Stop loss. And so whoever shorted, it could have been even in December on a lot of these, right? But imagine you shorted way over here and you kept moving your stops and your limits. And you keep moving your stops and your limits. But like if you were short here and you're like, well, next month's, this is going to be the January M1, and this is going to be the January S2. So I will put my stop somewhere in here, right? That would have been logical, right? I mean, isn't that, in fact, one of the things we talked about in the swing trading group at the end of the year? That if you were going to front run, like these levels are important and all that kind of stuff, and maybe we hit that by the end of January. Okay, cool. The only thing is it just went down, 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 pow! But these limits would have taken bears out. That's what I'm wondering. Like, there may not be bears left. They got their 1,000 pip move plus last month's 1,000 pips. So who's going to sell it again? Well, we don't know. Remember, it's not just patterns, guys. Don't get caught up in the video game mentality. We need other people to say, you know what? I didn't get the yen move, so now I'm going to do the yen move. But maybe all the institutional players that make the yen move happen did it and got what they wanted for it, right? Well, right. Well, AMFX, what happens is it starts at the end of January or at the end of December, right? Somewhere in December is usually what I tell people. In fact, the real number is somewhere between November 20th or wherever Thanksgiving is. So somewhere between the third week. Let's do it this way. Yeah, somewhere. Well, let me redo. Okay, this is really what it is. Okay, I try to time it better than this, of course, but this is really what it is. Somewhere between the third week of November until the third week of January. Okay, I expect the yen to get strong. You can write this down, but I will tell you next year as well. Don't worry about it. I'll tell you next November that this is going to happen. Now, I don't know when in the third week. Typically, it's more like the second week of December. That's pretty typical, okay? But I've given many stories where in the third week, the yen is getting strong, and I'm selling yen at that point, and I'm holding my breath. I can't even breathe because I might have 100 yen pairs long, and suddenly in the middle of Thanksgiving, the yen pairs are crashing, and I'm losing thousands and thousands of pips, and I have to decide, do I get out, or is it going to rally back up in another couple of weeks? Because that often can happen, and I don't know, so I'm freaking out. Right? I've given that story multiple times. It was one of the worst periods of my life. Right? So, okay, and then here very often you see a false rally. Well, this is now the second week of January. So what if so this year it moved to, let's say, December 1st. Not December 15th, right? So I was off a couple of weeks there. What if I'm off 1 week? And maybe this week's the big rally, false rally being it. But anyways, and not the third week. I mean, this is what I'm saying. Like, don't split hairs over things we talk about a year in advance. Okay? The yen pairs dropped 1,000 pips each. on the week I said they would. Cut me a break. Okay? And now what? They might reverse. Now, I told you a year ago that the third week of January we'd have some sort of rally, but maybe it's the second week, right? Like I don't know. If they're not, it's not, it's, you know, I mean, we got to be open-minded. Maybe we're a week off, you know. I'm doing these things 52 weeks in advance in some cases, right? So anyways, you got to be careful is all I'm saying. You can be a bear here, but ask yourself, if this is not a video game, if Kiwi yen is going to fall, again, another few hundred pips, which is within reason, we need evidence that other people are selling it, in particular big banks and institutions and import-export businesses and all this kind of stuff. Like whoever's trading Kiwi, somebody needs to dump this Kiwi. Or to say differently, buy the yen, right? You see, like that's what I'm trying to get you at. The bigger issues are the ones that we're talking about. Not which moving average and stuff. That's all tactical. If you're only tactical, you're going to get crushed on the long run. Okay? So you have to answer this question. Do you think Kiwi yen's going to come back down? Well, I'll tell you what. This will be a very interesting price for that to happen. None of the other prices are interesting. Okay? If you're a bull, continue with the price action. Until what? That's what I teach you in price action, right? Do this forever until it stops working, right? Up, 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 down, down, buy. 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 Up, 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 down, down, buy. Up, up, down, down, down. Take profit. Up, up, sell. Up, up, sell. Right? The key being more than that 786, more than that 100%. And this no longer support but resistance. Yes. Well, think of it that way, right, Michael? You're the one in control. You're the expert, right, Michael? So, where would you advise clients that were interested in selling the Kiwi yen? Where would you advise them is a key price level for us to consider as a group? They're the client, you're the advisor. And you say, well, if you had to get short Kiwi yen in the near term, I'm very interested in 73.5. Once we're around there, I will confirm that with technical analysis, and then I'll make the trade on your behalf. And I want my yellow Lamborghini in exchange, and not a Giardo. Okay? Not the MT4 video game nonsense that people do on their phones. Oh, I made $1,000. I'm going to buy a yellow Lamborghini. Grow up, child. Right? So, gold. No, oil. Let's do oil. All right. What did we talk about in great detail at $44 for oil? Okay. I'll put it this way. Did I say buy oil at 40, I can't see that, 42 or 43? Did I say buy oil at 43? I was a genius, right? I was an unbelievable freaking genius and said, put all your money on this, right? No. So I gave a long discussion. I think even this is the emerging market conversation too, right? Like we talked about this over several days, maybe 4 or 5 days, right? And it was $44 based on first and foremost, my macroeconomics. And do you remember back at the OPEC meeting back in October? I'm like, it's in January, we're going to start seeing evidence of compliance, right? So based on this big rally and the time of year and the analysis of the oil market and a bunch of other things, we said, hey, I'm thinking 44 would be a great place to buy. I think I specifically said in that case, which is a rarity for me, right? I think I would buy this at 44. I hope you can confirm that we talked about it 1, 2, 3, for 3 or 4 days. Right? Then what? Breakout? How do you trade a breakout? Roll reversal. Yeah, that I would buy 44 as an investment. Yeah. Well, you know, like I said, like what more can I do, right? What more can I do to say the yen pairs are gonna drop significantly the first week of January? And they drop 1,000 pips. Oh, well, I guess that was lucky. Yeah, of course, the velocity was lucky, and the amount of pips was lucky, but nothing else was lucky. That wasn't luck, right? Same sort of thing. So we identify support, and then what? Breakout, retracement, and off we go. Breakout, retracement. Is this going to last forever? I don't know, dude. I don't know. I just knew 44 seemed too low based on my analysis of the oil market or the energy complex. Remember, Brent was at 50, and we were sitting at 44. Remember, Brent was a big part of it. Okay? You notice, like, this was interesting, but, like, what do we do now? Well, dude, that was 500 pips ago. If this was measured in pips and not pennies, that's 500 pips ago. What do you want to do now? I don't know, maybe $50 on WTI is reasonable. And maybe this is going to be a challenge to get through because it's psychological. So I don't know what you want to do at 50, but I'd move my stop and be done with it, right? You see, like, if you got to trade your plans, right? And then, of course, if you've missed your actual trade plan, like, I think this is the key, the breakout pullback. Okay, but you could be buying down here. To each his own. And sometimes you catch this, and this is more challenging. Or if you missed it, like it occurred while you're sleeping, which happens, take the breakout pullback, because this is textbook stuff, right? And the rest is history. So would I be buying WTI at 50? No. No, I would not. But between 46 and 47 might be interesting. Okay? Pick your lines, right? Remember, the market's unpredictable, but you're in control of your trading. You're not in control of the market. But I could say, well, I'd be a buyer. I would be interested in considering being a buyer in this range. So if price did this, I'm going to sit up and take notice. What? Do I want to buy it here? No. 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 What's plan B? Would I buy it in this area? Yeah, maybe. I hope not. Right? Plan A. Plan B, look for either a bottom off this or a bottom off this. But somewhere in plan B territory, look for a reversal pattern, take a shot. Is that right, Jimbo? Nice. Good job on the target. It's unfortunate that happens more often than it happens a lot anyways. I can't tell you over the years how many times I miss stuff by like 1 pip, either an entry or an exit. But like a pip, or even I've missed things by like fractions of a pip. It just, what are you going to do, man? What are you going to do? Happens. So do you get this, guys? I don't know what's going to happen in the future. So I try to do analysis both technically and fundamentally. And I spend a lot of time thinking and pondering and creating hypotheses. Okay? Like when I talked about emerging markets, but not only that, like what does an institutional investor, like an insurance company or an endowment, what do they do when they're trying to earn 7.5% to 8% a year, bare minimum, just to fund their spending budget for the year? 8%. What are they going to do to guarantee themselves they're going to earn at least 8% if the stock market's only going to go up 5% this year? Where are their money managers going to invest? The U.S. stock market? Well, you know what? Those portfolios are probably already in the stock market. How about this? Let me ask you this. How much did the stock market go up before the big drop in, what was it, November or something? From January to November, does anyone roughly just a random guess? Was it 8%? Was it 10%? Was it 5%? What was the stock market peak, year-to-date peak, percentage-wise? S&P 500. It wasn't that high, was it? Does anybody know? Can I get a number? No, it wasn't up that much, was it? Was it really? All right, well, you guys must be right. All right. Well, so what I was suggesting, I thought it was less than that. But what I was getting right? No, I think it's the opposite, Jonathan. More people do what I want, right? More people trade in more predictable ways, and therefore, like for example, going to Jonathan's question here, like, aren't I sort of harming myself by teaching you guys how to trade? When I first started trading, this kind of stuff happened every day. Non-farm payrolls, moves 30 pips now? It used to move 300 pips in 1 second. And then very often you had a big pullback and then a big drop. So in the course of, let's say, 20 minutes, it would move 1,000 pips, just not straight. It'd be 300 pips down, 300 pips up, 300 pips down. Okay, so now what happens is the market moves very smoothly. And there's a lot less volatility, if you can believe that, than many years before. So if anything, it's better. Okay. Now, Charles Binder says it was down in 2018. Yeah, okay, before the drop. Yeah, 5%. I thought it was like 5 to 10%. But you guys are saying 22. S&P 500 year from January 1 to the peak was 22%. S&P up about 12% to November. Well, that's what I thought. So why are you guys getting 22? Ed and a whole bunch of other people got 22. I thought it was closer to 12. Okay? So anyways, what I was getting to is I think there is quite a few money managers already underperforming. And that even if you were the best trader, right, 12% was pretty lucky. And your clients have to have 8%. Imagine that, guys, that your break even to a lot of institutions as a money manager is 8%. If you don't get 8%, you're buried in the sand dunes between Abu Dhabi and Dubai. Okay, you got to hit that. You have to. After that, you're probably incentivized where you make basically no money up until 8%, but anything after 8%, they probably shower you with bonuses, right? So anyways, that forces investors to invest in other places. And if anything, if you're making money in the stock market, it forces you to get out of the stock market. So you're like, well, everything I'm invested in. How about this? Now it's like, if you look at the stock market in general, right? Let's say the vast majority of the market was doing hardly anything percentage-wise. And then you had your FANG stocks, your Facebook, your Apple, that kind of stuff, right? And let's say those were up significantly. Let's say more like 20%. So you had some of the market was up 20%. Most of the market closer to flat. So what does a money manager do that has to produce 8% a year, or they're essentially fired? The money gets redeemed and given to someone else that can produce the 8%. You don't want to do that, right? So you take profit out of your FANG stocks, NASDAQ comes down, right? And then what? And then now you got to buy all these mediocre stocks. But you don't want to buy mediocre stocks because then next year you're not going to hit your 8%. So what I'm trying is, where do you get the 8% in 2019? It may not be the United States of America, because we went from a bankrupt country to, the most powerful country in the world again. Because, like I've always said, the great thing about the American culture is that when things are wrong, when things go wrong, the American culture very, very quickly recognizes that something horrible has happened, and as soon as possible, they take the bitter medicine, right? Like a child would avoid it. Your kid has a fever, and you're like, hey, take this cod liver oil. No, 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 Daddy, don't make me eat the medicine, right? Look, not all medicine can be sugar-coated. So the American culture is take the medicine as soon as possible, no matter how horrible it is, fix it. And boom, 10 years later, once again, even 4 years later, richest country in the world again, boom, everything's going. The housing market comes back, the stock market comes back. Okay, great. Europe, instead of putting money in the market, what did Europe decide to do? Take money out of the market. Remember that whole austerity thing? Now that the market needs a government to step up, let's do the opposite. Let's pull money out of the market when the market's frozen. So now what? 10 years later, Europe is still choking on its own blood. Right? So anyways, I have no idea. Oh, so now the market is overvalued. By the way, remember when I was talking about repricing? Going back to key ratios, it's now the stock market's now at 16 times earnings, which is a ratio that tells you, is the market fairly valued? Is it undervalued? Is it overvalued? And that's a fair market value, historically speaking, for the stock market in the United States. And it was just a few months ago, it was like 20, 25 times earnings, which in the scope of the last 1,000 years of the stock market in the United States, that's at the 96th percentile, which means it was very, very, very expensive, almost so expensive we've never seen it that expensive before. Well, what do you need to do? Reprice. Take some profit, bro. Put it in the bank account. It comes down. So if they can't get the 8% next year, they're going to start investing in other places, probably Europe, maybe emerging markets. Because institutional investors have to make 8, but more like 10 or 15% a year. This is not money managers looking after grandmother's pearls and sending little Bobby to college. This is F you. I'm an insurance company. I gave you $1 trillion, and I need my 8% to stay in business. You give me my 8%, or something real bad happens, like death or redemptions. Right? So 10 or 15% is what these money managers have to do, right? So what are they going to do? Leverage up? Investors don't, right? Clients don't like leverage. So you might have to buy something cheaper. Well, at 16 times earning, you can get back into some, growth stocks or something. Value. I don't think you'll get value, but maybe you'll get some growth or some tech stocks anyways. And then maybe let's go to Europe and buy up Europe for cheap. So, Michael, I did like a 45-minute discussion about emerging markets last week. Might have been the week before. So that alpha is gone, baby. Okay? So anyways, don't be certain. Develop a hypothesis. Use technical analysis to confirm or deny. That's the message. Okay? So anyways, I loved it down here. I don't love it up here. That's all. That's come and gone. I hope it goes higher, but I'm not. Do what you need to do. Price action wise, you can play this all day if you're on the smaller time frames, right? Up, where you're going to look at the role reversal in here, so your next trade will be down and up. But you should know this, guys. I'm not here to teach you how to trade a 5-minute chart. Ian says, do you think the market volatility? Well, once again, this volatility stuff, this is chicken feed to what I grew up in when I started as a Forex trader. This is chicken feed. This is nothing. So, so there's that. The other thing is, remember, this is all seasonal. You watch. People are bitching and complaining about the volatility, right? By the time July happens and August happens, people will be bitching and complaining that nothing's happening and you can't make money in the Forex market anymore. We're at all-time lows of volatility. The markets are moving sideways. Nothing's, and they just all this noise. This is why I stopped, reading newspapers and I stopped watching TV. It's all just noise. My gosh. So I'll say stuff like, do you guys remember this in, I think it was the second week of August. And I discussed how I heard on Bloomberg that something similar like volatility is so low, trading is dead, money managers are having trouble making money this year, maybe this is a lost year. Do you guys remember this conversation? And the VIX was at like 7. I'm like, you know what? That's ridiculous. That you can't make money in the market and that investing's dead, right? That's just idiot stuff on television. So what did I say? I said, look at the VIX. 7 is way, way, way too low. But why is it low? And everyone's like, well, professional investors are on holiday. They're not making big investments in the middle of July. And I said, well, when do you expect the market to come back? And everyone said, well, third week of August, like I've been telling people every year, right around then you should start getting ready, right? I said, so we know between now and the end of August, professional traders will return, and I would expect they would want to make money, so they're going to probably trade because it's their job to trade. So they'll come back from vacation and trade, and therefore volatility go up. Does anyone remember that conversation? And I said, well, so if you think that's what's going to happen, then you would buy VIX. And VIX went up like something like 80% in like 2 days. Right? You remember that, Charlie? Right? So it's like all this noise, like this volatility. Dude, we talked about it so many times that at the end of December and the beginning of January, the yens were going to get ripper strong. Ripper strong. Right? I mean, so let's get away from the media trying to explain what's happening. Think of it this way, and this is why I go into the story. The markets are about institutional investing. Okay? Oh, you probably have to like Chicago Board of Trade type stuff. I think that's where it is. Right? You need a commodities futures broker that offers that kind of stuff, right? Yeah, Michael, right? It's too cold this winter. It's too hot this summer. Yeah, I mean, I found it after a while. So here's my life story in 10 seconds, hopefully. I used to read newspapers a lot because I was trying to teach myself fundamental analysis. In fact, I shipped newspapers in from other countries, like Japan. I had them flown in from Japan. Because I wanted to read what was going on in Japan. And I wanted to read the Financial Times out of London to get a European perspective. And then I got Investor Business Daily from the United States and Wall Street Journal. And at one point, I had something like 27 magazines related to finance and trade, like Import-Export magazine and stuff. I even paid like $300 a year for a magazine for the oil industry. And I had to pretend that I was a wildcatter. I had to take a survey and get invited into the club, and so I said, I was setting up oil rigs in Western Canada. Whatever. I stretched the truth a little bit, but anyways, I got into that magazine because I wanted to read about drillers and drilling, and I wanted to read their research and all this kind of stuff, right? And of course, CNBC and Bloomberg and all that kind of stuff. And the newspapers, I found over the course of years, didn't really do any research. They just reprinted Reuters press releases most of the time. And then in many, many, many cases, the actual reporting, like the one I always remember right away, is the Wall Street Journal completely wrote an article that was 100% wrong. A foreign exchange, right? It was actually about Ben Bernanke. So like I actually watched the interviews, and I read the meeting minutes and all that kind of stuff, right? So I know. I don't need the Wall Street Journal to tell me what happened at the meeting, for example, right? So here I am at the time, I'm reading the article, and I attended the meeting. I was in the room practically with Ben Bernanke, and I know exactly what he said, and the Wall Street Journal got it 180% wrong. And whoever wrote the article simply got a quote and then wrote an article around the quote. But Ben Bernanke was trying to be so clear where he said, if you think I said this, which then gets in the transcript, then you are mistaken. But what the Wall Street Journal saw was, Ben Bernanke said, not just if you think I said this, all they saw was, I said this. So they're like, this is what Ben Bernanke said, and this is what it's going to mean. I'm like, oh my God. If I traded based on what the Wall Street Journal just told me, I would be 100% wrong. Like it was a disservice. And I canceled everything. I just threw everything in the garbage, and I realized I was the expert. Probably a key moment in time, right? Like if I don't do the work, if I don't attend the meetings, if I don't read the reports, if I don't get the meeting minutes, then I am not an expert. I'm simply a fool. And a fool would look for ways out of doing the work. And they're like, oh, well, I get the Wall Street Journal, and the Wall Street Journal told me this. Well, that person that wrote it makes $60,000 a year and lives out of his car in Manhattan, probably lives 2 hours outside of Manhattan, right? With a journalist degree or something like that, has no idea what they're talking about. Probably started nobody wants to cover the Fed meeting stuff, so they probably gave it to this kid. And the kid says, I don't know anything about what the Fed's talking about. What the hell is the Federal Reserve Bank, right? And so the Ben Bernanke said stuff, and the writer's like, I don't know what any of this is, so I'll just wait for, I don't know, and then wrote this garbage. And I don't want that idiot advising me. So why would I look at the newspaper as an advisor, right? Like, this is what Ben Bernanke said. So anyways, I stopped all of that. No more. Yet. We do the work. We're the expert. And guess what? People pay experts for money for their advice and their guidance. That's why you need to do it. That's why you need to do the work. Fed meeting minutes coming out. Reading it? Actually, Michael says maybe the Fed should only do press releases in writing. Actually, they do. They actually do. Like the testimony in Congress and the Senate, it's over 2 days. They release the statement before the meeting, and then in this case, Jerome Powell would sit in front of Congress, well, the Senate committee or whatever it is, sits in front of the committee and actually reads the report that's just been released and actually reads it word for word, and then does Q&A, and then the next day reads the same thing. I don't know why, but reads the same thing word for word, and then they do another Q&A. Right? So anyways, I'm trying to get you to be the expert, guys. So I want you to think about, like, seriously, put some time aside today and say, if you had to make 10% with no leverage in 2019 as a money manager managing. So, like, for example, I'm writing a paper at Harvard this spring, like a real paper, like a research paper funded by Harvard. We haven't got officially done, but this is the plan. And so my research partner, he used to manage, I think it was $26 billion. $26 billion. Okay? So imagine this guy, he's overseeing $26 billion. And if he can't make 8% this year, like, oh my gosh, people are going to have to be laid off kind of stuff. And 10 or 12% is better because then you can put that into savings, right? But if the fund loses money, like, it's the end of the world, so to speak. Not really, but like, it's a real disaster. Like, seriously, people lose their jobs and things get shuttered, and it's a horrible, horrible thing. So you need 8% essentially to break even. So 10 or 12, right? What are you going to do in 2019 that is conservative-ish? Doesn't have to be ultra conservative, but is going to make your 10%. Let's say the number's 10. You have to get 8, but let's go for 10. What would you do? Remember, for many markets, $26 billion, isn't that scalable, right? Right? Like, you can't just buy $26 billion in dogfood.com stock, right? So what would you do? And think about it. And how would you spread it around? What does, what stocks would you buy? What bonds would you buy? Are you going to buy bonds that pay 2%? Are you going to buy bonds that pay 8%? What kind of bond pays 8%? Junk bonds. So do you want to put your $26 billion into junk bonds? Oh, that sounds rough, right? Are you going to put it all in the stock market? Was it going to continue going up, or is there going to be down? What if is there a reasonable chance the stock market falls in 2019? Or let's say does not go up 10%. Like, oh my God, you're like, well, if you're going to buy a stock, it's got to be really cheap, right? So that under the 16 times earnings, and then has a percentage growth. But then you'd have to buy it at scale, a stock that nobody's buying. And all of a sudden you're like, dude, I might be able to buy 10 million of that stock. But 10 million is nothing out of your 26 billion. So like you can't buy enough for it to be like, what are you going to do with your money? Well, you probably need to find a Spanish insurance company that is significantly discounted to its intrinsic value based on cash flows of, blah, 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 blah. And you need bigger buys, right? Where are you going to put your money? And then use that knowledge as a foreign exchange trader. Where in the world is this money going to go? You see what I mean? Yeah, right, Charles? So, but seriously, this is this thought process, guys, that will help you become a foreign exchange trader, because I think it's the institutional side that is moving these markets, okay? It's not retail, it's the institutional side, and that's why you suddenly see FANG stocks coming down in, let's say, December or November, right? Because these institutions, they're looking for ways to earn that 8%. And they're like, oh my God, 3/4 of my of our portfolio, like bonds, are not paying enough. The vast majority of our stocks are up, but they're not up that much. The only thing that's up 20% is my Apple stock and my Facebook stock, right? My Google stock's up. So what do? They take profit there first, guys. And those markets come down, and then what? Anything they'll wash out some of the losers and the stuff they want to get out of, and they wash all that out. The stock market comes down, and then then we have a taxation issue in January, right? Did they want to cash out in December? Some for tax reasons, yes. Some in some cases, but when do you want to get cash out of the other stuff and defer your tax bill? Well, that's going to be the other component, the first week of January, because now you push off your taxes by 14 months. But I've explained this 12 weeks ago, 26 weeks ago, right? And that's what happened. So now, if you want to think beyond your 15-minute chart, is this 5A cross going to be a trade? Think, right? Spend a little bit of time. What are these investors doing that have 10, 15, 20, 30, 100 billion, $500 billion? Where are they going to put their money in 2019 so that their institutional investors, their clients, the insurance companies, the endowments, make their 8% or better? And if you can figure some of that out, I think you'll see the foreign exchange market move along with that logic, because it's them making the foreign exchange market move, because only if money crosses a border does currency change value. This is why we're saying, like, if only U.S. institutional investors are cashing out of the stock market, right, what are they going to do? And what if foreigners are buying? Like, what, you can track all of that in using correlations and stuff. So anyways, let's get back into this. Sorry, I preach and teach because some of you never had this. Okay, so where would you sell if you happen to be a bear? Price action. All right, that's just price action. This breaking is a failure of moving averages. Okay, and then pivot points. I would have had this as plan A, but it hasn't worked. You probably didn't get an entry. So let's just mark this now as plan B. Somewhere up around 125.50. 125.5. You're going to be interested in looking for reversal patterns in which you will sell. 1, because you're a bear. 2, because you've identified a cluster of weekly and weekly resistance. And okay, so let's do that. Weekly R. And then you got price action. Okay. So if you're a bear and you found weekly resistance and price action resistance, so now you have price and market. So you can do it like this: market resistance, price resistance. Okay, now if we get up here and you zoom in now to maybe a 15-minute chart or a 5-minute chart, and you see you have permission to fire for effect and take this market back down. Anything above that sucks, and probably you shouldn't be a bear anymore. Cool. Well, that's important information, right? Frey, I don't think I've seen that evidence. Well, it was at Forex.Today. Every non-farm payrolls, Jonathan. I've been doing that for 13 years. Trade non-farm payrolls live the first Friday of the month. Well, okay, so let's go back to Michael's question. If this is the false rally, how high should the euro yen go, for example? All right, well, let's define that. Okay, what would an uptrend be? Okay, let's say we think this is going to go up forever now. Okay, we're convinced this is going to go up forever. Well, that would mean we're going to be up here, right? So by definition of false rally, it's not going to go that high. Okay, what are the other key levels that we should mark? Well, let's mark this with a better tool than that. Okay, and it's not going to go higher than that. Okay, and this is an interesting level technically. Okay, and the plan I just gave for you was sell in here or don't sell at all. What do you think of that? And you notice by the time you get there, this daily 21 will be down there meeting us and greeting us. See it, Jeanette? Do you see that? Sell there if you're a bear or nowhere. That needs to be confirmed on a small time frame with technical analysis. So you got to move from a daily to like a 15 or even a 5. And use technical analysis to confirm that other people. Yeah, I did a bunch of Swissy pairs for the swing traders. And yes, sorry it went so long. Day traders, the room is opening over at FX Bootcamp. So if you're doing the day trading group, that's over there. All right, so I looked at Swissies, for example, and I said, doesn't this look better than like Aussie yen? See, we looked at Aussie yen, and let's say you wanted Aussie yen to fall, but there was like, you had like a key pivot below. Let's say price was here, and you had like a mediocre pivot here and a key here. Like it was just hanging out in a zone, but there wasn't hardcore resistance in which to sell. It was just sort of in the zone. Does that make sense? And I'm like, well, that doesn't look that exciting. It could go up before it goes down, which we talked about today. But then I look here, and you see that? That's resistance, right? Like if you needed to take Aussie Swissy down. And remember that comment, like, you know, this was only yen pairs, for example? Well, you can see here it wasn't only yen pairs. So if you wanted to be a bear, this is market resistance, faux show, and price resistance, right? So what I mentioned, I guess it was 14 hours ago, that this might be an interesting place to sell Aussie Swissy. That's what we talked about 14 hours ago. And certainly better than Aussie yen. Same sort of risk off, but much better than Aussie yen. Okay. Okay. Bulls would buy here. Bears should either trade a top that's off of a pivot point, right? So for example, this is the exact price a weekly bear is supposed to sell. I know, right? And then plan B here would be down into support, probably up into here, and then down. Okay, so that was the second one I shared with the swing trading group 14 hours ago, that would be a better sell than Kiwi yen. It's the same macro, just better technicals. And then USD Swissy. Check it out. Microphone check 1. Okay, this is the sell zone. This is the price action. Okay, and down we go. Okay. Looking at it on an hourly chart, maybe it's going to be clearer. Okay, 14 hours ago, we were in the sell zone. Looks like somebody sold it off of the monthly central pivot, which isn't that shocking. Okay, down, 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 down for 1, 2, 3, 4 hours. What do you do now? Look left, drag it across. Oops, that was supposed to be an arrow, sorry. Up, okay, and down. And I guess on an hourly basis, it's just gone. Now, on a smaller time frame, on a 15-minute chart, it's down to the 5, down to the 5, down. And this is called ride the 5. Okay? And I always thought that would be a great name for a super yacht. Ride the 5. Hello, Mr. McDonald. My name is Johnny. I'll be your helicopter pilot today. So where are we going? Well, Johnny, we're going to my yacht. Ride the 5, baby. Ride the 5. So anyways, any last questions? Cool. If you like my chart template, click the link below the video. You can download all my chart templates. If you want to join the day trading and swing trading live trading group at boot camp, you need to do that. We just started last night and today. In fact, a lot of people are moving over to that. If you want to be a cool kid, become a client of tradersway.com. Traders Way makes these daily videos available to you. You need to pay that back. Okay? If you're not ready now, then open up a demo account. But at some point in time, to show your loyalty and respect, you need to pay back the goodwill that they're showing you by opening up a live account at tradersway.com. So go there now, today, do the demo, takes 30 seconds, download the MT4, you can test the execution spread, the execution speed and the currency pair spread. Meanwhile, you can download all my chart templates and profiles and indicators and all that kind of stuff and install it onto your MT4, and you'll be super happy. You'll have the same trading setup that I have, and it'll be yours, compliments of the firm. Okay? Gold, gold, gold. Everyone's saying gold, gold, gold. Okay. I'll do gold. I'll do gold for you. Okay? And by the way, if you're new, subscribe so you can attend the next webinar. Okay? Gold! Okay? First of all, we're out of position on a monthly. Okay? So you're supposed to use the 4-hour 21. It's not really, well, I mean, it's maybe this time it's 4-hour 55, but it's something. But this does indicate a slowing down. Okay? The monthly target, as you already know, as a bull is 132.25, maybe 1314. Let's just say 1300 to 1325. Okay. Now I have to go back into a smaller time frame. So if it goes up, the higher it goes, the less likely it's going to go higher. All right, cool. So if you were a bear on this using a weekly swing, you're taking this shot, right? But this is the price in which you were supposed to sell, and that's $12.91. So this might just sort of pop up, hit 13. Well, wait, that's too high. Well, that would give us a double top. And that would be the R1. And remember, I've been talking about an R1 S1 week. Don't be shocked if we have an R1 S1 week. So we'll probably stay within this range. Okay, that's what I'm breaking down into pieces here. If you were a bear, however, and using just a weekly swing, this was the price, and you were supposed to like take this down here. But you can see that doesn't seem likely this week. It's plausible, but your plan A would be here, plan B is here, and this is probably more like it. Okay. And now what about bulls? Well, this isn't very good price action per se. You could argue this a bottom, this a top, and then you would mark this like this, and you'd take this across, and you would probably want to set this up like that. Right? That's probably what you're thinking on a short-term time frame. Like, it seems aggressive to me, but whatever. To each his own. Okay. If you're a bull, I think you would have to consider that. Another way of doing this, of course, is Fibonacci. Okay. So this isn't a great. Let's go here. This isn't a remarkable selling price unless I'm missing something on a bigger time frame. Why that price? Well, something's been going on there for a long time, right? So this line is where we are now, right? It should be more like this. All right, so but is that why it's falling? I guess. So let's drop into, again, a smaller time frame. Yeah. So I still find it sort of hard to buy here. And this grayish zone is a sell zone. There's a sell zone above us. There's a sell zone. So, right? So we're kind of looking at it this or this. But it seems hard to buy it into that. I think like this was a beautiful buy right here. All right, that was beautiful. This was like gorgeous. This is out of position, which is actually a warning. Okay, this is a warning. And what's the warning? Aaron, for day traders, yeah. So you can go over there if you're a day trader. The warning is it's overbought, and when you hit the target, a lot of people are going to get out. Okay? Because what happened is they didn't get out here as they were supposed to. They might have gotten out here, but they bought back in, and now they're letting it run to next week, and they got that. So when they hit, it's going to come off harder. So long story short, it can go up here. It could. It can. I'm not saying it will. It could. But I think what I'd be looking for is, like that, I think. If the dollar continues to weaken, that's a very good thing. Remember, I think dollar weakening is a good thing. And if that happens, then gold will likely go up. But does it, okay, that's true. But as a professional investor, let's say, let's go in here. Let me change it. Let me clean this up. Oops. Well, you know what? I'll leave it here. Okay, as a professional investor, do you think it's wise to buy in this zone? Do you think you can make a career of buying at that zone? So the one thing we know, guys, is that would be a terrible place to buy. Yeah, don't buy there. You're right. You could have bought here. You could have bought here. There's lots of things going on here if you wanted to be a buyer, for example, right? But buying up here, this is somebody else's sell zone. Okay, at the bottom of that, in the middle of that, and then just above that, we know there's a pivot, right? So if anything, this is a profit-taking zone and a bearish selling zone. So bulls would sell there, bears would sell there. Probably a bad place to buy. So that kind of sets up my logic. And if you wanted to be a bull, at least say this is range bound for a while or something, right? The only place on a 15-minute chart I think you could consider is that kind of and we're there now, like I don't even know how to draw it, but I guess like this, right? But all you're likely to get out of it is this amount, because the higher it goes, you're going to run into trouble, like I said earlier, here and a little above. But maybe it's just a day trade, which is fine. Okay? So think about it that way. Who's going to buy here? Who's going to sell here? And the sellers might be bulls because they're taking profit on their longs. To offset their long positions, they have to sell. See what I mean? So a bull would sell first, and then the bears would sell into the vulnerability, so on and so forth. So just think about it that way, right? Always ask yourself about the other trader on the other side of your trade. All right. I will see you tomorrow. I'm hoping that maybe I'll have more screens up. What do you think? Okay, so we're talking. So we spent a lot of talk about institutional investing. I hope you don't mind that. I want you to learn how to think like an institutional investor. And even if you stay a retail investor the rest of your life, or in this case, a retail trader, I still think having an understanding of why and how the markets move is critically important so that we can seriously, like, come on. Like the first week in January, the yens are going to get strong. I must have said that 1,000 times. Like, no joke, literally 1,000 times over the last 10 years. Yeah, like literally 1,000 times. And the yens got ripper strong. They did. I mean, like, well, how does one do that? Understanding the institutional play. Okay? Understanding the institutional play. And then kind of trading along with it. But more importantly, being there waiting for the institutional trader to make their play. Okay? So here's your bullish entry, guys, if you're a bull. Oops, I didn't need that one. Template, standard. There's your cycle. Okay, I don't know if it's going to go up, but if you wanted it to go up, okay, that gets interesting. Okay. All right, gotta go. Oh yeah, sorry. Good. This one. I dropped it into a 5-minute chart. Okay. And I think originally the play was off here, right? So anyways, your call. All right. Frey, you need to ask tomorrow, Frey. Okay. You need to ask tomorrow, Frey. Make sure you subscribe, okay, Frey? Thank you for being clients of tradersway.com. Become a client of tradersway.com if you have not as of late. Cheers.